I'm Don Norton, President of the Illinois Agricultural Leadership Foundation. You've received this DVD because you've expressed an interest in developing knowledgeable and effective leaders to be policy and decision makers for the agricultural industry. We appreciate your support of our mission. On this video, you'll see Dr. Paul Ellinger, Professor and Department Head in the Agricultural and Consumer Economics Department at the University of Illinois. He's speaking to our class of 2014 on three key issues for 2013: budget, economy, and budget. This was videotaped in February 2013. I hope this session provides you with valuable insights about the agricultural industry. Thank you again for your support.
Well, great. It's good to be here again and formally introduced. And I'd also like to extend a welcome. This is actually a very good group. We've done this, I think, with this group. I think I've given presentations to at least the last three classes that have come to campus. It's a really good group, and as you indicated, what Ron indicated at his opening, Ron has informed me of all the people who have come through this program and that as well. So you should be proud that you're actually part of this very distinguished program. What I'd like to do today is talk about the budget situation. As Jonathan said before, sort of everything drives through the budget right now. And the last time I gave this presentation to your previous group, obviously things have changed since then, but the top three issues then, we said it was the budget, budget, and budget. But we thought we'd at least throw the economy in there this time because the budget is linked into the economy. So I wanted to talk a little bit about some of those kind of factors as we go before. My objectives as we go through here is sort of what Ron had said at the outset, is to get you more informed about some of the general parameters. We all know yield per acre, we all know nitrogen bushels per acre, but do we know sort of effective what the employment numbers need to be coming out at to achieve a certain rate, or do we know what some of these other factors are? Those aren't necessarily in our topic of conversation. So I guess I would, to give you sort of a bit of a background, again, sort of like the primer on some of the terms. I won't necessarily be talking about the sequestration. I think Jonathan did a nice job talking about that process, or about the budgeting process per se, but we're going to talk more about the budget parameters and sort of how we got here and that. The other thing is really going to look at this through I'm not going to I'm not going to be on the left side. I'm going to try to be in the center here. If you know what I mean? I'm going to report the economics as they are and the budget as it is. I'm not necessarily going to take a side that there's a party that got us here. There's enough blame to go around. So I'm not sure it's party related. So I try to keep that sort of independent as well. And that's sort of reporting a lot of the numbers from CBO. And again, they don't necessarily wear a partisan hat as well in terms of giving the best estimates, given the parameters that are set out and laws that are in place at this point in time. That's their best forecast. I think you're looking for she's got those up there. And that as well. And also I heard you actually went to the Federal Reserve, so we're not going to talk a real lot about monetary policy. Most of this is going to be on the fiscal side, as we did, but we certainly can talk about that. Obviously, you can't talk with one without the other because they do interact. When I work with lender groups, obviously monetary policy is a big issue, but since you already talked to that group, we can do that as well. So again, I want to provide a little bit of a historical perspective, so we get a lot of graphs and we can make it interactive and that as well. So again, my objectives is just to be better informed about the main drivers and trends. Talk a little bit about the consumer and housing, labor, corporate, and then get into the budget situation. So how we got here and sort of the depth of the problems that we're in. I think sometimes we think we've been through this before. History repeats itself, so this is just another cycle. This is unique. This is actually a really fun time to teach. Fun defined very broadly, time to teach economics. We're doing things we've never, ever, ever done before. Economics textbooks are being rewritten. And so it's really fun to engage, and quite honestly, to engage with students that we're doing things we have never done before. And do we know that they work? Jonathan said, we don't know. We don't know if they work. And we're doing things and as well. There's obviously a lot of tug of war at times between some of these things. Having very, very low interest rates. Who does that hurt? Your parents probably, right? And your grandparents. So not necessarily hurt, but look at what impacts it has. So a lot of times there's winners and losers in these types of things, and that as well. Okay, so the other issue getting back to this sort of bipartisan view, and I disagree a little bit what Wojciech said earlier today. This idea of not having very high priority on sort of the health issues. Part of that is. And not that is a low priority. Part of it is that's a really long, to see output from that, that's a long-term investment that you're making, and you're not going to see sort of marginal impact. So it's really harder to make that a higher priority simply because we are very short-term focused. And that's the same as the corporate world. One is we have to get reelected, but on the corporate side, we see the same thing. We had the former CFO of ADM up here about 6 or 8 months ago, and talking about one of the biggest problems in corporate America is our big attention to the next earnings announcement. And so we're sort of worried about the next quarter or the next quarter's earnings announcements, those kind of things, and we're not necessarily doing things for the long haul. We're seeing that live right now with some of you that follow Dell Computer. What's happening? They're going private, right? Why is he going private? Maybe you can fix things and not be under the arm of shareholders and be able to do certain types of things, and then hopefully make a good investment in that as well. I think in some cases, when we look at some of the farm policy things, I think in a case like with health and fitness, that's a long. He talked about 50 years for smoking. I think we're probably looking at a longer time to really do those kind of things. So anyway, where do we start on these kind of things? There's a lot of things that have happened. We're going to try to do this at the end of a day after we've talked to a lot of things. But I'd like to go through some of these things as we look in the past, some of the headlines that we see, and some of them aren't very, very exciting. If we look at things like Illinois stops paying its bills, can't stop digging, borrowing cost, Illinois, the third depression. So a lot of headlines during this crisis, early part of the crisis, that were very troubling. So as we start through, I want to start with this. About a year and a half, it's a year ago, November, we were downgraded, and people sort of remember that time frame. Okay, what was S&P's explanation of why they downgraded? Remember? Anybody? Why did we get downgraded? Uncertainty. That was one of them. They gave two really big reasons. So the debt to GDP was getting sort of unsustainable. So we had too much debt. What was the other one? Anybody know? Debt and caustic lawmakers. And this isn't opinion of a reporter. This was S&P said those are the two factors that were part of this, and people that didn't get along. So as Jonathan talked about, we're coming up against some more deadlines coming up again, right? And he talked about there's going to be a battle again. Are either one of these things gone away? And so as we look at what it's going to affect to the financial markets, will be quite interesting. As we had this problem before, a big part of this was due to right after we couldn't do the debt ceiling debate. This was our downgrade was shortly after the debt ceiling debate, which goes to the next graph I have here. This is a sentiment index, and this is sort of how good you feel about the economy. And you might argue about why that's important. There's strong connections between that and consumer spending. So we don't need to go into the statistical correlations, but just trust me on this one. And then, which one's the? Well, if you look at this piece right here, this was a debt ceiling debate. Okay. So this is a low point. So as we have this debate again, what's going to happen to not only what they have as an outcome and how it affects our economy from an explicit standpoint, but what it happens from the uncertainty that's out there, the uncertainty in the markets, uncertainty in the financial markets, the uncertainty in the stock markets, and so kind of things. That created a tremendous amount of uncertainty during that time. Okay. this is the only equation. We are academics, so we got to put an equation here. But I put this up only for the reason that when we talk about the income that we have for our country, that's the GDP side. The percentages are things to pay attention to. What drives our economy? 71% is the consumer. 13% investment, 19% government, and then we're a net importer. So if we had exports, that would be a positive number. Compare that. So the message is we're very dependent on the consumer. It isn't necessarily the consumer got us out of the recession, but it has to come along. And so as we see the health of our economy, it's going to be driven by the health of the consumer. So I'm going to spend a few minutes talking about how healthy is that consumer. Not from a Wojciech health standpoint, but from a financial health standpoint. Just as a comparison piece, China is only 36% of their economy is the consumer. They'd like that to be more. Us not doing well, Europe not doing well, hurts Japan, or it hurts China in a big way. And so they'd actually like to see more consumption internally to be less dependent on these other countries and as well. So let's look at, this is a really, really neat graphic. Most of these I've taken from someone else and acknowledged here, so I can say I'd like to have done this, but this is really an interesting history lesson about what we've done with our GDP in the past. So if you look at the top, I'm going to see if I can. Do you know which one of these is? Okay, so across the top are different expansion periods, points in time in our economy. So if we go back to 49 and 50, and this ordering here, this is what we're spending our money on. This is that same graph that we had before. It adds up to 100%. So today, 47% of our GDP is based off of services. 24% on durable and non-durable goods. So services, transportation, things going to restaurants, things going on vacations, transportation, services, service sector, and as well. So that's the largest piece of our economy. Then we come down here, durable and non-durable goods, things we eat and things we drive, and then state and local government. So this is the ordering of what we spend our money on or how our economy has. We go back over time and look at how that's changed. If we go back in the 40s, it was 36% of goods, a lot lower on services, and then federal government spending was actually a higher percent over time. So it shows you a little bit over time.
Is that somewhat of a cultural change, or is that due to
Yes. Well, most of it's due to the change of the way we look at things. So if we look at it from a goods standpoint, our service sector, as we've evolved as an economy, our service sector has gotten bigger, right? And that's our service sector in Illinois is quite large. If we look at where we lost jobs in manufacturing, how do we make them up? We make them up in the service sector. We've become a service sector economy for the most part, and less manufacturing. So it is, so it's sort of kind of funny, but it is sort of a change in what we've done. So goods, producing less goods because where are we producing, where are those goods being produced, and where do we get the income on that? A little bit on home building, you see that's come back down again from the peak here, and exports obviously when it's negative. So it gives you some perspective of what we've done. Then again, a lot of graphs, but allows us a good conversation to understand how we're spending our money. But in this case, how this has changed over time, housing has steadily increased from 25% to 33%. Our food side, and that's what you all are going to argue, is that why do we have government policy related to affordable food? We only spend 13% of our budget on food, which is the lowest, I think, now in the world. Clothing and shoes, very little, and then everything else here is 49%. And the other things that's happened in the last decade and a half, or almost 2 decades, I guess, is what's been our big increases? Pension, well, how much money we're spending on pensions, how much money we're spending on health care. Education's been pretty flat. And education, this is out-of-pocket education. So this is it's not what's coming through the tax revenue side, and as well as what we're actually paying out of our pocket for education costs. If we were to look at this graph for China, one is this would be closer to 40 to 50, and they will spend another about 20% on healthcare because they don't have the healthcare system that we have, and they will be in double digits with education. In terms of what they're spending out of pocket, ours is sort of implicit with our taxes, our property taxes, and so forth. We're paying for education. We're just doing it not through this venue, but they spend a significant amount in education, and we're benefiting at Illinois here as background. It's even different than when Mr. Bowman was here. About 14% of my incoming class next year will be from China. So it's not your father's ag econ department anymore, and it's healthy. These are very, very strong students, and makes for a nice domestic international mix. But they're spending a lot of money to bring their people. They value education in a very, very large way. Okay. So, and then here's as we talk about what's actually happening with the economy. So every quarter we get a report of our change in GDP. That's usually what we talk about. And actually it went sort of underneath the radar, but we were actually negative in the fourth quarter of 2012. Okay? So definition of what's the economic definition of a recession? You need two of those, right, Michael? So technically, there's not a lot of people forecasting this, that there'll be another negative piece. People think that Sandy was part of this and so forth, but a slight negative here. But what, as a general rule of thumb, the argument is if we can keep that at sort of 2%, we can there's a very likelihood that we'll be able to maintain job growth. So we'll need about a 2% bump to maintain job growth as part of that. The forecast, not mine, but the Federal Reserve forecast, what we're going to have with that same number. And again, I think everybody realizes this, these are all annualized numbers. And so even though these are quarters, it wasn't 2% growth in that quarter, they annualize that number. So when we talk about what is our growth at 2% a year, 3% a year, but they'll talk about the third quarter growth, that's simply annualized to that point. Okay? So what they're forecasting for right now, this is the band of what their expectation is, both short term and long term, about the future growth. And this is what's driving some of monetary policy, is their forecast of what GDP is going to be doing. Okay? Now, I thought this was helpful to look at. Again, we're going to look through a lot of numbers in terms of the largest economies and look at how we're aligned. Before we get there, where do you think we're at in 2016? What do you think the order is? What? Off the screen. Who's first? No, we're still first. Who's second? China. So if we look at it, if we grow over time, 2005, 2011, you can see China, if we go back, and the only thing that's really changing a lot from here is China's here, then China's moved up, and you can see China's moved up to 6.5, and then a little bit lower than that. So we're still the dominant economy, but you can look at there's a wide gap between 1 and 2 and 2 and 3. So as we move forward. So what's up with housing? This is the graph I always like to show. This goes back, and this isn't a typo here, it's 1890. This goes back to 100 years. And if you're at 100 here, that means that the house was increasing at the rate of inflation. So just think of 100. If the house prices just changed at the rate of inflation, you'd be. So the 30s were down a little bit below. Does this, in hindsight, look like a bubble? So as we look at and part of the reason why these other ones are on here is what other factors you'd think, because China is actually, well, I may show that, I may have the time to show that a little bit later. China is 4 times this. But they have other economic factors that are leading to that. There are people moving from the rural areas to the urban areas. There's a lot of economic growth in those areas. So there's some economic rationale behind that. But for us, Our population wasn't changing, interest rates weren't changing, cost of housing wasn't changing, so there was obviously something else to support that. So what actually happened, and this is obviously a story that everybody knows about, we got a big decrease, and we're sort of stumbling down here with the different housing indices for different places. Okay? Now this is one that I don't think too many people in the rural areas realize. We purchase farmland, and usually we put at least 35% down or even 40% down. If we look at the underwater mortgages in the United States now, the national average is 22%. So 22% of the mortgages that are outstanding now are upside down. Okay? Oh, that's a good question, Ann. I think we would have been in low single digits. Low single digits. Part of this, I don't think I have the graph here, but one of the things, the other differences between China and here is that we liked the home equity mortgage. We liked it a lot, and the banks liked it a lot. How many for those that had this, how many did you get in the mail every day? Multiple times. It was very easy. You could do it in literally 30 minutes online to get a home equity mortgage. And so we saw the house prices going up that we saw here. We just kept borrowing as we went up. When we had the recession in 2001, housing prices still went up. So we didn't have to slow down our cash. We kept spending because we were able to borrow. We can't do that now because our house went down. We don't have that cash ability to do that. But the depressing piece, and this number has actually gone down. It used to be 65%. In Nevada, I think it's over 80% in Las Vegas. 80% of the people are upside down on their mortgages in Las Vegas. So, yes, we can make this interactive. Why don't they just turn it over? These people aren't all late on their payments. Why don't you just give it back to the bank? What? Yeah, why don't you walk away? What? I think it's going to go back. So a lot of these people, these aren't all non-current. They're still paying on these loans. It's just like if you had a house, if you had farmland and you were upside down, but you were able to still make the cash flow payments. It doesn't mean you're bankrupt. It just means if you failed that day, you're not going to be able to make the loan. But a lot of these people think that housing is going to recover and so forth. So. There's some of that. I think there's some of that. Some of it is that we're passionate about our house. Of all the things we give up, if our car gets, we don't care if our car leaves, we don't care if our other assets leave. There's something about our house that we don't have. And so, but the problem is, and I'll show you a graph in a little bit, is that America in general, again, not on the farming side, we've relied very heavily on that as our savings account. Our retirement fund was our house. We didn't save. And now that's gone away. So I brought out Illinois. I think Illinois is about 9th, and so the top 5, and I think California is almost next here. So these are sort of the sand states per se, but this doesn't indicate a very healthy consumer. 2 is what did your grandparents do if they lost their job and there was a job opening in Nebraska? They moved, right? Well, if you're upside down in your house, what do? You reduce your labor mobility. You reduce mobility because of the housing side. So you don't necessarily want to you may want to give it back to that, but you sort of think it's going to go up, and as well. So that's slowed that piece down. Here's another piece of what we're looking at, and this is more on the delinquency side. And you say, well, all these gray rural areas are really good. Well, be careful reading here. It only measures the metropolitan areas, so we're not measuring the rural areas here. So if we look at the areas that we're looking at of where the delinquency rates are, obviously really still heavy in Florida, Las Vegas, California are large, and again around the collar counties around Chicago area are relatively large in the Northeast. And so these are actually delinquency rates where people are not paying. So still a lot of significance here, and this is just the most recent data that we have. And then just more data on, is that slowing down a little bit? So these are all problem loans, so if you add them all together, so the bottom part is 30 days late, then 60 days, 90 days late is typically severe delinquency, and then foreclosure. So we are going in the right direction, but in answer to Andrews, where were we in 2004, 2005? These numbers were back in 2% and 1% before. Okay? So let's look at the other sort of, we didn't get into it or didn't have the time to do it to get into how we got there with the housing prices and the housing bubble and so forth, and who was at fault, whether it was the credit rating agencies or whatever. But you can just generally argue that a lot of this was based off of the data that we had, the data that the analysis used, the data that the lenders used. For those of your lenders in here, how many times did housing prices go down from World War II until 2005? Hardly ever, in terms of from a national standpoint. So all of our models, if you just, you don't have to be a modeler to think about, if you've only got data where the number goes up, what are your models going to say? Data's going to go up. And so when you look at this, the argument of some of these special derivatives that were there, it's sort of like, what's the likelihood of all, what are you, 40 of you in here? What's the likelihood of all 40 of you defaulting? All of you. Very little, right? Suppose you're even all 40 of you are subprime borrowers. What's the likelihood of still all 40 of you defaulting? Very little, especially in the past. So why not take half of you? I'm not going to say half, which half of you? I'm going to take half of you and say that's AAA. Okay? You're all subprime borrowers, but I'm going to put you on a pool of $50 billion and sell half of that as AAA. That's in 2 minutes or less. That's sort of the basic concept. That not all 50 of you are all going to default. Only half of you, and it's unlikely that half of you will. When you're in a crisis, you sort of get this contagion effect, and that's sort of what happened here. This idea of what happened in the economic sectors, I didn't include it here, but the likelihood of the forecasting models of what actually occurred in the financial markets was equivalent in standard deviations terms to winning the lottery twice in a week. So the forecasting, you talk to the forecasting models were wrong, but it's all based off of, if you base it off of history, good science, accurate models, maybe not good models, accurate models in terms of how they were calculating these things and as well. So we can argue about that later. But if we look at the labor market, this is a number that we pay a lot closer attention to. Some people, if you're an economics term, is sort of following, like it's like going down and looking at the commodity prices. You're looking at which Friday when they're going to announce the new labor numbers. But there's two numbers that I think to pay attention to. One is the unemployed, which is just fairly obvious. But the underemployed are the people that are still actively, that may have dropped out of the job market, that are still actively looking. Or people who are working part-time that wish to be working full-time. Because one of the deceiving, I think one of the things that sort of goes unnoticed here on the unemployed side is once you quit looking for a job, you're no longer unemployed. Okay? Once you stop looking for a job, you're no longer unemployed. Does that make sense? So we can have improvements in the economy coming up, and we've seen some improvements where we actually could see the unemployment rate going up. Does that make sense? You come back in the labor force. So in some ways, you have to be a little careful of interpreting these numbers and that as well. And we'll come back to the labor numbers as well. The savings rates are depressing from a U.S. standpoint compared to China, which is 30 to 40%. We got down in the crisis somewhere around 1%. But if you do it on numbers, about 48% of the people in the country spend more money than they make. Okay? What? 48? 48% spend more money than they make. Okay? And so why would we do this? A is that we were relying a lot on our house in general. So our house prices were increasing. And we just didn't save very much. China, again, being a lot higher in the past. We were much higher than we were in the past. But one of the issues here, do you think it would be a safer economy if we did save more? We probably rely less on China and so forth. So from that standpoint, we're safer. Collectively. Okay, and what else was that? What happens to our income? Yeah, so if you're going to put an extra $1,000, $2,000 in your savings account, you're not buying a flat screen TV. So when we go back, that's why I put that initial conversation I had about consumption. As we want to do this to be a healthier economy or healthier individual, saving more, that's not, if we're looking at a headwind in our economy, that's going to be a headwind in terms of how much we're spending. Basically, the government would like you spending flat screen TVs instead of savings, because that would do those kind of things. And so that's a sort of a headwind that we have associated with that. Now, these are just some more numbers, and I'll go through these relatively fast, just to give you, again, the terminology I think is what's important. We look at this participation rate. This is what I was talking about before. Why can we get unemployment rates to go up and down? Participation is the amount of people who are actually of our economy that are actually participating in the labor force. So if you're, once again, if you're out of work for a certain period of time, no longer receive unemployment benefits, you fall off the rolls, and then you're not included in the labor force. So you can look at participation rate has declined substantially through this, of people just not necessarily looking for jobs, the inverse of this. Okay? And then the employment to population ratio, which is this number. This is of all the people in the United States, what percentage of people are employed. Okay? This is one that I like to keep up, and again, we're doing a lot of graphs, but it tells you that we are a bit different than we have been in the past in our recessions. This is, again, not one that I follow, but there's a really nice site that if you're interested, this calculated risk blog has a lot of this. It has some really good data and good charts on an ongoing basis. But the way to interpret this is this is full employment, which is, if we look at our economy, 4 to 5% is what our government in the past has viewed as full employment. And so each one of these V's or each one of these lines represented a recession after World War II. Okay? Each one of these little boxes represents 0.1% of labor loss. So we lost unemployment so much per month down to this level. So, and this is our current one that we have right now. So we can say that we lost a lot more than we ever have in the past. So we're a lot deeper than we've had in the past. And we're certainly not, I guess it's U, it's a big V if it is a V. So the pace of recovery, it's obviously in the right direction, but if we look at in the past, we're just much deeper than we were in the past, and it's taken much longer to get out of this than it is in the past. So each one of these represents a month this direction. So it took us longer to get there, and it's taken us longer, obviously, to get back. The other statistic that people pay very close attention to is if you've been out of work for half a year. And why is this important? One is related to you start losing skills. You start losing contacts. Just think of you in your own job. You start, even from professional side, you start losing some of the types of things that got you where you were today. So are you as employable after 26 weeks in terms of that? We've had some recovery in that number, but that's a number that people pay pretty close attention to as well. I found this one. This one is sort of unrelated to that, but the gallons of gas bought by an hour of work. This isn't necessarily something that people follow, but it's a way we can sort of relate to those. It's sort of like a parody thing that we were talking about before, but this idea of gallons of gas that we bought. So if we go back in '98, we can get 14 gallons of gas based off of an average hour weight, and now it's about half of that. So in terms of the cost of what we can do, how far does a dollar go as well? This highlights, again, I'm going through this pretty fast, but this is actually fairly important to look at it from a university standpoint and from y'all's standpoint. This bottom line are people who have bachelor's degrees, the unemployment rates. So if you look at this line, this is the bachelor's, these are people who have BS's. This line is less than a high school diploma. So if we look at the unemployment rates for the less educated, much, much higher than the other piece. And so when we look at policies related to certain types of things, who's unemployed, you can really drill down to these statistics in a big sort of way. Now here's one. This next set of graphs is I've done this. It illustrates unemployment by every county, and the darker it is, the more unemployment. So if we go down here, and we started back in 2007, and I think the perception a lot of people had is this was a coastal thing, or this was a big city thing, or this was related to certain areas. And so we're going 1 month at a time here, and this is on a county by county basis. And as we move forward, you can see we're filling in. So this was not just an urban issue. This is not a regional issue. other than, I guess you can figure out what's going on here. Population's low and not many jobs there. So fewer jobs sort of in this sector, but significant. And this is when they stopped collecting it in this format. And the next slide I have is what it is today, but we got a little different scale. So be careful what we have here. But it's the same. But we've actually changed the legend. And this used to be the dark number here. So we're still significant amount of unemployment, not just in the Chicago area, not just in St. Louis and Peoria area, but throughout the entire state. So we've got unemployment. So this isn't just an urban issue. It's obviously a rural issue in that as well. Okay. Illinois situation for jobs. Again, we lost a significant amount of jobs between 1990 2000, 345,000 jobs. 38% of our manufacturing jobs. The growth primarily came in the service sector. Okay. Lower paying on average. By 2008, over 43% of the workforce did not have employer-provided insurance, and 30% of the population is either on Medicare or uninsured. So the Illinois situation, and I don't know if I included that graph, but we now are the worst-rated state in the country. Our pension program is the worst rated in the country as well. I want to talk about this. This is the graph that I think they showed you at the Federal Reserve, just to remind you of what happened to the Federal Reserve's balance sheet. Again, this is not the government's balance. This is the Federal Reserve that's managing monetary policy. These are the different programs that they had, but the significance, they basically tripled the size of the balance sheet. If any of you did that in a matter of 5 years, I think your lender would be a little concerned, right? So obviously there's good use of some of those. The concern that people have is what that's going to do. And Ron said, did you ask that question about what's it going to do to inflation? That's obviously the concern. Can you unwind this at the pace that you can? Right now, you can actually, the market has. You can look at different indices that actually, what is the market's forecast of inflation? May not be right, but what is today's? It's sort of like what the futures price is. So this is the market forecast of inflation. So the market forecast of inflation, and you can sort of see when it goes up or down. The market forecast for 10 years is about 2.5, and the 5-year rate is 2.16. So this has been inching up from the middle of last year as well, and the bond rates are sort of illustrating that today. Okay. Then I think talk about the one. This is a graph that I think is helpful to look at, and one that it probably not many of you realize is that now student loans. We have more student loans than we have credit cards. And if you think about is this, and I'm not sure bubble's the right term, but this is student loans here, and credit card loans are right here. So we look at student loans are now exceeding all these other pieces. Bankruptcy doesn't take these away. You file for at least the current law. I'm 99% sure the current law does not allow you to write off your student loans. So those student loans are going to be there. On average, we like to say that we're doing well. On average, 50% of the college grads didn't get jobs last year. Here, we had, I think my department had 85% of the people that were looking for jobs either went to graduate school or did that as well. But it's put a lot of pressure on academic institutions who will be offering certain types of degree programs and so forth, and that as well. Okay. Now, I like this one for a couple reasons. One is to look at, and I should do this sequentially, but if we look at the write-downs, and this is a little dated now, but the write-downs are almost actually $2 trillion today. So these are all the programs that were related to the financial crisis. So these are just losses that occurred, GSE program, commercial paper, TARP, some of that money that was paid back and so forth. But this is what we gave to Citibank, AIG, Fannie and Freddie. And so from here to here, this is what we at least expended as part of this. This is the entire farm debt here. Okay? This This is banks, Farm Credit, and everybody else added together. So part of that is sometimes I have a hard time getting my hands around $1 trillion. I know Jonathan, he's got that in his head. He knows what $1 trillion means and those kind of things. But I have a hard time really conceptualizing it, so I have to compare something. So we took all the farm debt and compared to the size of these other numbers. What we actually did for Fannie and Freddie was about equivalent to this as well. Okay? Now these are what's kind of fun to compare. Well, fun in a sort of absurd way, but this is what we lost on the S&L crisis. Why is that so much less than this? Any idea? And then Marshall Plan. These are in today's dollars too. So the Marshall Plan. This is for those. This is the economic things we did in Europe after World War II. So basically revitalizing Europe. Korean War, Louisiana Purchase. So the S&L crisis. Why is that so much lower? Is that, remember, in that case, it was confined to an institution. That institution failed. End of story. What happened here is we had. Think of it as if your great-great-grandfather was still living, and your great-great-grandfather lent a loan to your great-grandfather, and the great-grandfather had a loan. So everybody lent to everybody else all the way down, and everybody lent at 95%. So when you failed as the bottom piece of that, everybody failed. Okay? When we are so interconnected in our financial markets now, when one firm was failing, we had sort of this contagion effect on that as well. So it's a different kind of banking crisis when you have this interconnected pieces of it. So we had a lot of these things that were failing. And so in that case, that's why this was so much bigger. Okay? So let's look at a little bit at the budget situation as we have. This is just some background about where do we receive our revenue. About 47% of it comes through individual taxes, Social Security, corporate taxes, customs, excise taxes, and state gift taxes. So most of that's coming through individual taxes. Okay? So this is just, it probably should be at a pie, but most of it is coming through individual taxes. This is, I got the same graph, I think, same set of graphs that Jonathan had. These are. Is that a little bit, number 3, I think. Okay, this is, I think it's the same graph you had, isn't it, Jonathan? So this is actually from CBO, the Congressional Budget Office, again, the bipartisan entity that does a lot of the forecasting to look at the federal debt held by the public as a percent of GDP. So all the graphs that I'm going to put up are not going to be in dollar terms, but as a percent of how much money we make. So think of it as your debt or your income or your expenses as relative to your debt, because then we don't have to worry about sort of conditioning that on time. And that's what people are concerned at. There's a couple really good books that are out there that go back over crisis and say, at what point in time is it unsustainable? You all know in your own case, there's a certain point where you're not going to be able to pay back debt. There's a certain amount of debt capacity that you have. Okay? Now, what's also helpful to look at is and you might see this term, this is our actual GDP, and then our potential GDP is if we were at full employment, we were at full capacity. This is the gap that we could be attaining in our country, and this is what we're doing now. So we've got a gap here of a couple percent here between what we could be doing and what we potentially could be doing. And what's the source of that? Part of that is state and local government purchases. A lot of this has trickled back down to the state side. How many people have we had, schools that we had to lay off, and so forth. Federal government purchases are part of that. Residential investments are part of that. And consumer spending. Business has actually improved, and actually some growth in some of the emerging markets in that as well. So these are the factors that are really putting headwinds away from our full GDP. Unemployment rate we've sort of talked about, but these are projections as we move forward. And Jonathan had this, I think, in his graph before, to know at what is the percent. I think if I forget the next page. What is our percent? He had it, I think, in dollar terms. This is our percent of our GDP that we were in deficit. So each one of these bars, so we're almost 10% here. we go back to World War II, the highest, I think, was 6%. Okay? And so sometimes it's helpful to go back a little bit farther, but we sort of blew through that here into these 3 periods. So we talk about the deficit, how significant it is. And if we look at these are all more than 6%. And the forecast going forward, we're never above the line here. And we're still at levels that we didn't really have in 2004, 2005, but we've blown through those as well. So these are with all laws in place that are in place today. That's how the CBO does this, and then they'll do some scenario analysis. But this is based off of their February, what they reported in February of this year. And then this is a nice one to get some ideas about, and we'll trickle on this. Our average outlays as a percent of GDP has been about 21% here, if we do this over time. This is how much we're spending as a percent of our country. And this is over time. This 18% number is a number to sort of pay attention to. This is our revenue line. Okay, so this is the revenue line of on average through different tax regimes and so forth. But that number has hovered around 18. We can go back even before that, and that 18 number, 17, 18 number, I think is fairly strong. That goes actually back to 73 here. And so as you can look at, the gap between this is our deficit. But one of the concerns that people have when we look a little bit farther down the road is, I'll come back to that number. Is this number here? Is that if we, again, this is a little alarming, but our entitlements both with Social Security and Medicare, this is where we're at today, and if we went out to 2050, if we kept that 18% average, we're paying for Medicare and Social Security just with the 18%. Okay, so part of that is the elephant in the room. When we talk about reforming entitlements, obviously this is something that sort of needs to be done. It's a hard political issue, right, Jonathan? It's a very hard political issue to address because it affects a lot of people. But it sort of needs to be done. I can go back here a little bit with some of the. So if we look at these forecasts, think of, I guess, in percentage terms, and think we were bringing in remember that 18% number. 18 is sort of what, at least with our current plan, 18 is our income. Okay, so the healthcare programs are going to consume about 6% of that. Social Security is going to consume 5.5. So we're at 11.5 there, just with healthcare, Social Security, and then Jonathan talked about discretionary versus non-discretionary, and this net interest could be 3%. So if we even look at this, 6, 12, up to 15, just with interest and healthcare and Social Security, we're at 15. You talked about making budget cuts of everything else, right? I think we have to pay our interest, right? I think China's going to want us. Everybody else is going to want us to pay our interest, and that's only going to go up if interest rates go up. They can't really be much lower than what they have today. So that's really a concern as we move forward. Now, this is a nice. This was in the top 10 graphs of Wall Street Journal here this last year, but this is the way to interpret this one is that in 2000. CBO made their forecast, so you could say how accurate were they, but part of it is things changed since then. So in 2000, their forecast or 2001, their forecast, this is what they projected our deficit or surplus to be, and that's how to interpret this. So in 2003, this was their forecast. In 2007, this is their forecast. And then obviously what we had here. So this idea, the forecast that they made in January 2001 was for a $5.6 trillion surplus. And what actually happened was over here as a result of these various factors. So again, the emphasis point is here, maybe not all the numbers, is that the depth of the problems that we have here are fairly large, and as well. Okay. I'm not sure I want to talk real deeply about this, but Social Security issues, it is one of the elephants in the room that people don't talk about a real lot. But it said unless changes are made, trust funds will be exhausted in 2039. And the shortfall is about 0.6% of GDP or 1% of taxable payroll. So the idea is, and the way to put it in real terms, because a lot of Social Security is based off of people who are paying in at the same point in time. So if we go back to 1960, the number of workers, each Social Security beneficiary, so everybody who's getting a payment, there's 4.9 people that are paying into that system. That's how to interpret it. So this idea, I think it's the same thing that maybe Wojciech said this morning. If we go back today, that's 1.7 up into 2080 and that. So in summary, in terms of from the economic side and economic indicators, the things that are going well, stock market, we're at a recent high. Exports are actually, in the ag exports are going well. There's a lot of cash, a whole lot of cash that are out on balance sheets of a lot of corporations that are out there. More cash than we've ever seen before. And why aren't they why isn't Apple putting up a new plant in Minnesota or in China? Nobody's buying their machines, right? So it's just an economic factor. Capacity utilization by companies, earnings reports have been pretty positive, but the idea is that unless you see top line growth, unless you see the opportunities to invest and get additional revenue, you're not going to necessarily see that investment by corporations. So there's cash ready to do it. And some companies are doing it. And corporate profits have been pretty strong. Capacity utilization is really hard because what we've done is we've cut out a lot of fat. You know, a lot of your companies, some of you that work for companies have laid off people. It gave a really good opportunity we've increased our bottom line. This is pretty easy accounting. If revenue isn't increasing and your income is increasing, what's happening? You're reducing cost. And what's our biggest cost in most of these cases? Labor. And as well. So we've really squeezed out a lot of the costs. We can only do so much more. But the headwinds we got, still a weak labor market, the European debt situation, and things that I've noted on here as well. Just included a couple of these things in China just to show you the magnitude of the size of the price index from 2003 2010, ninefold, 6 years. Okay? And if we look at our housing peak, so if we can compare it to Japan, if we compare our housing peak, we're 1.5. Look what's happened in China. Just significant. And this is sort of unrelated, but a nice cocktail party statistic. As we look at things into the future in terms of who's going to have the young workforce, with Europe being older, China having a one-child policy, looking out in the future, United States may have a higher percentage in terms of change of the younger population. Okay. Well, let's leave it for a question here. Any question? We got a few minutes left. I may show something that's somewhat comical at the end of the day, but it's not that educational. It is. It actually is very educational, but I want to make sure we have. I'm sure we can go over a little bit. Any questions? Not terribly exciting news.
So the student loans, what do you see that? Do you see anything wrong with that, or is it just climbing until
I think we have to do a better job of financial literacy for these. I think what's happened is that these things have been very easy to get. And I think we have we as universities need to be more responsible people are going to schools that are very, very expensive with not looking at their jobs at the other end. So some of this is related to the economy, but some of this is majors that are very difficult to hire in. And in a down market like we're in now, it's good to be in a business school or an engineering program or a program like mine, is that there's a lot of, food sector, it's wonderful. Our students are getting great jobs, high-paying jobs. Example, my son is an accountant for John Deere, and his girlfriend was an English major. And I'm sure there's probably an English major in here somewhere. Can't get a job. So we do a great job with sort of the business, because people now are narrowing it down. If I want somebody that's more dirt ready, more ready to actually do things rather than, because if I get the English major, I've got to train them for a year and a half, and I want somebody that's got those accounting skills, I want somebody that's got the finance skills, I want somebody that knows about the ag sector, I know that the prices can go up and down and those kind of things. And so part of that's education, and we've really, Illinois' tuition is, we're the second highest in the Big Ten. If we've thrown Northwestern out, and by some metric, we're even the highest. And so we can't do that anymore. We have to do other things, and part of it is the colleges. We spend a lot of resources that isn't always on the education side of things. It's on all the other services. You see the expectations of having nice healthcare facilities, and the nice things related to having the dormitory types of things, having dealing with international students and having these sorts of certain centers. So a lot of it'd be good investments, but it's raised the cost of education because of the expectations that people have had on this. So there's not a real silver bullet answer other than we quit loaning as well. So.
I'll go ahead and take it. You talked about the international students. You're going to have a lot more international students in your classes, and you also talked about the increases in tuition, needing to pay for these things. Do you think the increase in international students has anything to do with needing to pay off some bills and tuition is higher?
No.
Or is it taking away opportunities from local Illinois students?
No, I think what we've done is we've made the criteria. Actually, we don't we never did this before, but we as a department, the university manages all admissions. We never see. I mean, if some of you that have followed some of the problems that 3 or 4 years ago, and it's always been this way. I think the trend is just simply there's more applications coming international that we've never seen before. Partially because the growing middle class that's in China right now is that they have more money to do this. And so it isn't necessarily we're bringing those students in that we didn't bring in the past. Just like they're eating meat now instead of rice, they have more disposable income and they value add education really, really highly. So they're competing very readily. So I don't think it's an economic motive from the university standpoint in terms of this. It's very high qualified, especially the engineering program, extremely qualified students, perfect scores and ACT test score. There's very high quality students that are coming in here. The average ACT score in my department has increased 1.5 points in the last 3 years. It's not all due to the international, it's a competitive place to get in. We benefit from that. We have good students. We have very good students. Sometimes we wonder how some of these students get in, but that's usually that's usually a behavioral thing, not necessarily it's not a capacity issue. But that's what you'll hear a lot of taxpayers say. But I think it's not necessarily substituting for someone else getting in. And I would recommend. I'm going to get on my recruiting hat here. I truly want more downstate people applying to our program, and I'm not sure why we aren't getting more applications. A couple things that have changed, and to some degree, some of you are from rural areas or not. If you come, the university calls these low-sending counties. If you're from a low-sending county, you actually get a few more points in your application. So if you're in an area, because partially a lot of the criteria based off of academic scores and class rank and those kind of things, and so sometimes some of our rural schools can't offer some of those kind of things. And so if you succeeded very well, my high school class was 18, so I was a low-sending county, and as well. Somebody's from Chatsworth in here, right? I'm from Sonneman, so. Other questions? People say should we get the housing sector going first, or in my opinion, it's all about getting people employed, getting people, whether it be small businesses, whether it be elsewhere, but getting jobs. So just think of what that does to a household getting $70,000 job versus a $30,000 job. What you're doing. So it's incentivizing, in my opinion, incentivizing businesses to make investments, incentivizing companies to maybe bring back some of that the money across the seas, and in terms of from a tax standpoint. But giving incentives for job growth of some type, I think that's my opinion. I don't know, Jonathan, what do you have a? let me show you. This, if you stay, I think you'll. I'm a little cautious of. This is my opinion. This is actually. So you heard about quantitative easing, right? And what it was, and so forth. And this is actually a comical version, and it makes fun of Bernanke in here. And I'm actually a Bernanke. I think Bernanke's done a nice job. But this is sort of a nice way to end the day here if we can get the technology to work.
Did you hear about the Fed?
No, what about the Fed?
They announced another round of the quantitative easing.
What does that mean?
It means they are going to make large asset purchases via POMO.
What does that mean?
It means they are going to expand their balance sheet and buy treasuries.
What does that mean?
It means they are going to print a ton of money.
So why do they call it the quantitative easing? Why don't they just call it the printing money?
Because the printing money is the last refuge of failed economic empires and banana republics, and the Fed doesn't want to admit this is their only idea.
So why do they want to print the money?
Because they say we have the deflation, and the deflation is very bad.
What is the deflation?
The deflation is when prices of the things we buy go down.
Isn't that good? Doesn't it mean the people can buy more of the stuff?
Yes, but the Fed said this is bad, especially during the recession.
So they think that during the recession, when the people have less money to buy the stuff, it is bad that the prices go down?
Yes, the Fed would rather have the inflation.
So why does the Fed think we have the deflation?
Because the CPI said so.
But aren't the food prices higher than a year ago?
Yes.
Aren't the gas prices higher than a year ago?
Yes.
Aren't the healthcare costs higher than a year ago?
Yes.
Aren't tuition prices higher than a year ago?
Yes.
Aren't the taxes higher than a year ago?
Yes.
Aren't the subway fares higher than a year ago?
Yes.
Aren't the stock prices higher than a year ago?
Yes.
Aren't the bond prices higher than a year ago?
Yes.
So what is deflating right now?
The only thing deflating that I can see is the Fed's credibility.
Did they have a lot of credibility to start with?
No,
Why not?
because the Fed has been wrong about every major economic development in the past 20 years.
You mean they didn't see the internet stock bubble?
No. In fact, they helped fuel the internet stock bubble.
And they didn't see the housing bubble?
No, in fact, they helped cause the housing bubble.
And they didn't see the subprime crisis?
No, in fact, they told us subprime problems were contained right before the shit hit the fan and we even went bankrupt.
So has the Fed ever been right about anything?
Let me see if I can think of anything. No, nothing.
Who runs the Fed?
The Fed is run by the Ben Bernanke.
Does the Ben Bernanke have a lot of business experience?
No, the Ben Bernanke has no business experience.
Does the Ben Bernanke have a lot of policy experience?
No, the Ben Bernanke has no policy experience.
Has the Ben Bernanke ever run in an election?
No, the Ben Bernanke has never run in an election.
So what qualifies him to run the Fed?
I don't know, maybe the fact that he has a nice beard.
But my plumber also has a nice beard, and I would not trust him to play God with the economy.
No, although when you call the plumber to fix something that is broken, they usually fix it, not break it more.
This is true. The plumber is clearly smarter than the Ben Bernanke.
Well, that is why he became a plumber and not an economist.
How does the Fed execute the quantitative easing?
They print the money, and then they buy the treasury bonds.
Do they buy the treasury bonds from the Treasury Department?
No, they buy the treasury bonds from the Goldman Sachs.
You must be shitting me.
No.
So let me get this straight. If I want to buy the Treasury bonds with my money, I can buy them directly from the Treasury.
Yes.
And if you want to buy the Treasury bonds with your money, you can buy them from the Treasury.
Right.
But if the Ben Bernanke wants to buy the Treasury bonds using the American people's money, he does not buy them from the Treasury, he buys them from the Goldman Sachs?
Exactly.
And does the Goldman Sachs give him a good price?
Of course not, they are the Goldman Sachs. They make their living ripping off the American people.
But how is the Goldman Sachs able to do this?
The Fed announces what it is going to buy and when it is going to buy before it does the trade.
So the Goldman Sachs can front-run the Fed and give them the worst possible price on the Treasury bonds?
Yes, exactly.
And the Fed is okay with this blatant theft from the American people?
Of course, otherwise, the Fed would just buy the Treasury bonds directly from the Treasury Department.
Who inside the Fed is responsible for the buying of the Treasury bonds?
The buying of the Treasury bonds is conducted by the New York branch of the Federal Reserve.
And who is in charge of the New York branch?
The head of the New York branch is the William Dudley.
And what did the William Dudley do before running the New York Fed?
Before running the New York Fed, the William Dudley was a partner at the Goldman Sachs.
So the guy in charge of the American people's money when dealing with the Goldman Sachs used to be a partner at the Goldman Sachs?
Yes.
And nobody has a problem with this?
Apparently not.
Is this an episode of The Twilight Zone?
I don't think so.
Are you sure?
Pretty sure.
So what you are telling me is that the Fed thinks prices are going down, when in fact they are going up?
Yep.
And they think during the recession, with the high unemployment, it is better if the things people need to buy cost more money.
Correct. According to the Ben Bernanke, the inflation will create the jobs and improve the housing market.
Has this ever been tried before?
Yes, just last year the Fed tried the quantitative easing with $2 trillion.
Did that create the jobs?
No,
Did it help the housing market?
not at all.
Did it help anybody at all?
Yes, it helped the Goldman Sachs.
How much of the money are they printing now?
$600 billion.
So even though the first $2 trillion did not create the jobs or improve the housing market, the Fed decided to do another $600 billion anyway?
Yes,
Who put the Ben Bernanke in charge?
the Ben Bernanke was first appointed by the President Bush, then he was reappointed by the President Obama.
But wasn't the President Obama supposed to bring the change?
Yes,
How is putting in charge the same fool who has been wrong about everything, the change?
well, under the President Bush, the Ben Bernanke only blew up the American economy. Under the President Obama, he is working on blowing up the entire global economy.
That does not sound like the change we can believe in.
Definitely not.
Who else supports the Ben Bernanke?
Most economists around the world think the quantitative easing is very dangerous.
Does anyone think it is a good idea?
Yes, the people at the Goldman Sachs.
Is this some kind of nightmare?
No, it is very real.
I want to bang my head against the wall.
You should not do that,
Why not?
because the healthcare is too expensive.
Didn't President Obama fix that?
No, but that is the subject of a whole other video. Goodbye.
So, I mean, there was some truth to that, but there's some stretches of that, but it's an entertaining way to look at this. But anyway, it's been a great to be with your group. Again, I think you have my contact information, and I think you're going to be out at Farm Credit tomorrow, I think so.
Dr. Ellinger, on behalf of the class of 2014, thank you so much for your participation in putting on the conference.
Thanks, Jared. I enjoyed it.
Thank you.
Thank you.